So it looks like we have about 31 on this afternoon. So good afternoon. Um, Happy Thanksgiving, Merry Christmas, all those fun things. I hope everyone is staying nice and warm. Um, I'm so glad that you are joining us today. I see a lot of people that I know. I see a lot of people that I don't know. So, for those that don't know, I am Tammy Ford and I am with the Blount Partnership. Normally, throughout the year, we have a multitude of workshops and different in person things here at the Chamber. But in March, as with all of you all have done the same thing, we converted all of our things into a virtual platform. We've had a few in-person things, but for the most part, we're still doing things virtually. So here we are again doing another virtual session. Hopefully next year we'll be back to doing some things in person. When all the COVID stuff broke out, we had a lot of interest in PPP forgiveness and recipients and what do you get, what you don't get, and so I think initially a lot of those questions got answered. But as you think about it, as you're closing out for the end of the year, I know if I were running my business, I would be very concerned on what I needed to do in terms of any tax implications or things that I need to make sure that happened by the end of the year. So here we are at the end of the year. And as you can see by the attendance today, people are concerned and people do want to know how to navigate this process and what all they need to do for income tax purposes. So we have two experts in the field that are with us today from PYA. I say PYA. I still am a little bit hung up on the Pershing Oakley just because I've been around for a very long time. But PYA is becoming a new normal word for me. And PYA does work all over the United States and really is a huge firm in this area. So we're glad to have you all with us today. We have Debbie Ernsberger and Mark Brumbelow. Did I get that right?
Yeah.
Good. And so what we're going to do today is if everybody would mute themselves, that would be the first order of business. In a moment, Debbie is going to kick us off and talk, and she'll have a slide deck presentation followed by Mark. And then throughout and at the end, if you have questions, you need to type those in chat, not chat for us to chat about today, but for them to really talk to you personally after this is over with about your very specific question. So we're going to capture the chat and then I will be sharing that with them and they will follow up with you individually. And I get that because everybody has a different circumstance and different perimeters and different variables. And I found that early on in all this COVID, they would say, well, what if I work from home and I get this and I get this money and I do this, but what if this? So everybody's got their own story. So I'm sure there's just not a one story fits all. So thank you, both Debbie and Mark, for willing to talk to these folks after it's over with today. Enough of my going ons. Both Debbie and Mark, I'll just tell you, they have a very extensive, can y'all see that? A very extensive bio. And I'm not going to read it because here's what I need you to know. They're very well respected in this area. They know exactly what they're talking about. They do this all of the time. So with that, Debbie, I'm going to turn it over to you to start us, and then we'll go to you, Mark. And don't forget, if you have a question, to put it in chat. And then both of them will also be putting their name and their email address if you needed to reach out to them directly. So Debbie, I'll give it to you.
Thank you, Tammy. We are very appreciative of the opportunity provided to us by Blount Partnership to be with you today. Wish we could be in person, but virtual will have to do right now. I'm going to drive the presentation on the slides, so please don't judge me on my computer technical skills here. So hopefully all is going to work. Our topic today is what's next for the PPP recipients, navigating the forgiveness process. And finally, planning for the close of 2020 for income tax purposes. I don't know about all of you, but I'm certainly ready to put 2020 in the rearview mirror, although I'm not positive at least what the first quarter of 2021 is going to look like with this new surge that's coming to our area. But we wanted to spend some time talking to you about the Paycheck Protection Program. Really, you know, the PPP has been at the forefront for most of 2020 for so many businesses. As we've continued to try to navigate this pandemic, those funds were a lifeline for so many businesses. And now, as we're closing out 2020, we have to think about the tax treatment. The beauty of the PPP was that those items of income were not going to be taxable if forgiven. But then on the flip side, we have to plan for those expenses that may not be deductible. So it's really important as we close out 2020 to think about maybe some of those unintended tax consequences. Hopefully the slides advanced. I'll look at Mark to make sure that they did. Okay, perfect, Mark. My name is Debbie Ernsberger, as Tammy said. I am a principal specifically located in our Knoxville, Tennessee office. I am originally from Maryville, Tennessee, so a Blount County girl. And with me today is Mark Brumbelow. He's our managing principal for the tax service line, also located in our Knoxville, Tennessee office. So we are thrilled to be here with you today. Just so you know, my focus is going to be just laying the groundwork to talk about the PPP. I'm going to level set everyone just from a foundational standpoint. And then Mark's going to drive the majority of the conversation as we move into income tax planning and considerations. So with regards to the PPP, most people know, you know, really when you think about it, the U.S. was a bit, I would say, shut down starting around March 13th. So the CARES Act was signed into law shortly thereafter. And quite frankly, I think you know, the government bodies worked pretty quickly to provide a lifeline to so many businesses as we, you know, look to such unprecedented times. The funding for that original PPP funding was $349 billion, and that funding ran out by April 3rd. So we had a second round of funding that provided for $310 billion. And when that window closed around August 8th, all of that funding had not been utilized. So there was some funding that still was there that businesses did not obtain. There was one amendment to the Paycheck Protection Program Act that was very important. It took place in the first part of June, which really was a saving grace to so many of the borrowers. You saw so much of the guidance when we've talked about the PPP, when you've heard the comment, building the plane as we're flying it. We really were doing that with the PPP. I mean, that guidance was changing every time you turned around. But luckily, so much of that information that was coming out was really friendly to the business. And in particular, with that amendment that extended the use period of those funds from 8 weeks to 24 weeks. One thing I wanted to just point out on the PPP, when you look at some of the information that's been supplied, in particular by the Treasury Department, the state of Tennessee, there were right under 100,000 businesses that obtained a PPP loan. And when you quantify that, that was right under $9 billion. So that's a lot of money that came into the state of Tennessee during the time frame when so many businesses needed it. So most people know as you receive those PPP funds, you have to use them for payroll costs or non-payroll costs. Payroll costs primarily have to be at least 60%. Most people are aware you're looking at gross compensation. You can look at payments for vacation, medical, sick leave, separation or dismissal. You're looking for what the employer paid for healthcare benefits, for retirement benefits, and what the employer paid for state and local taxes, so SUTA taxes. So you're focused on what the employer is funding for payroll costs. I will say with regards to this percentage, we have seen more businesses than not, because that use period was extended to 24 weeks, that amount that they're using for payroll costs is well in excess of 60%. So we're seeing if people can say the majority or almost all of my funds were used for payroll costs, that's what they're electing to put on their forgiveness application, mainly because they feel like it will be a cleaner application to submit to the lender and the SBA, and hopefully get them to the other side of 100% forgiveness. With regards to non-payroll costs, again, that has to be limited to 40%. You can use it for mortgage interest payments, rent, and primarily we see if people are using, reflecting anything that's not payroll, they're primarily indicating some utilities for the funds that have been used. So we're going to quickly move through the loan forgiveness application, and I'm sure many of you have seen that application. There's a Form 3508, which we're going to highlight today just for simplicity purposes, and the Form 3508EZ. So the 3508 is certainly the more lengthy of the forms, and it comes in four key parts. You have the loan forgiveness calculation form, and you have a Schedule A, and you have a Schedule A worksheet, and then you have an optional form for the borrower demographic information. I do want to highlight there's some additional forms that have come out recently, most specifically the Form 3508-08S, and that is for any borrower that received $50,000 or less in PPP funding. This form, if that's where you fit, you need to use that form, because it's much more simplistic, and it provides the organization an assumed exemption from any reductions for the borrower's loan forgiveness amount on either full-time equivalent employees or any reductions in employee salaries and wages. So if you fall under that threshold, you need to use that form. And then also the Form 3509 and Form 3510 have been released. The 3509 is related to for-profit businesses. The 3510 is nonprofit businesses. This is what's referenced as the loan necessity questionnaire. So what happens on this form is once the lender approves your forgiveness application and moves it to the Small Business Administration, they may, if your threshold, if you receive PPP funds in excess of $2 million, they may send you this form. The form is very much kind of a drop-down response questionnaire, and it's very, very specific as to the necessity. I think there's only 2 places there where you can even type in a response, and it's limited to so many words. The important part of this form is that if the SBA does send that to you, you have 10 days to turn it around back to them. So what we're recommending, if people do fall into that threshold of above $2 million, they need to go ahead and pull that form and start pulling the information needed and prepare it as if they're going to receive it from the SBA. There, move forward. Okay, so on the screen, you're going to see the example of the forgiveness application. I'm sure many of you have already looked at it. But one thing I do want to highlight here is you need to be very sensitive to the expiration date, which is at the top right corner. This one says expiration date the end of this year. This just came out yesterday. So I think this is the third Form 3508. They keep moving it forward a month, but you need to make sure whatever form that you're using and then that you submit to your lender and then the SBA, you need to have the most current form. So I'm just telling you that to be a little bit sensitive to that form and the expiration date. The next page lists the Schedule A as well as the Schedule A worksheet. The one thing I want to highlight on the worksheet as you're walking through this information, so guidance has been released to say you're not going to receive forgiveness in excess of what your PPP loan was. So for instance, a lot of people on this worksheet, their payroll costs are going to be for that 24-week period in excess sometimes of the PPP funds. that is fine to list that there, but then you need to add another column that basically pro rata reduces that compensation amount to equal your PPP loan. So that's kind of a little bit of an extra step. I've seen some applications where the payroll costs that they list are way in excess of the PPP funds, and you really need to limit that to whatever your PPP loan was. That'll also go into effect as you're kind of looking through if you had any reductions in salary, as well as any reductions in the FTE count. The next page just relates to the optional form, the demographic information. The one thing we do want to highlight on all of the PPP application process is that once you submit the application form, you must maintain that form and all supporting documentation, even if that supporting documentation is not submitted to the lender and the SBA. You have a requirement to maintain that for a 6-year period after full or partial PPP loan forgiveness. So it's important that you either designate someone or designate a place where someone knows where all that information is, should the need arise to gather it within that 6-year window. I'm going to quickly kind of walk through the components of gathering that payroll data. Many of you know there's 2 different covered periods that you can look at for payroll. The default covered period is the 24 weeks. We look at it in a day time frame, so a 168-day window, or you can elect to use the alternative payroll covered period. This really was more of an issue when it was the shorter window of usage period, the 8-week. But if your payroll period started, let's say you received your funds, the date you received your funds deposited into your account started your window, your covered period. So let's say you received those funds on April 20th, but your payroll was not until April 26th. You could elect for payroll purposes to start that covered period for 168 days starting as of April 26th. Another some key important words as it relates to the loan forgiveness is paid or incurred, or is the really key word here. You can look certainly at payroll that was deemed paid on the date the paychecks were distributed, or the payroll was credited into their account. But you can also, if you need to, look at a incurred period. So the date someone earned their compensation, if it falls within that covered period, even though it was not maybe paid, you can count that in that payroll calculation. And you can include furloughed employees as well. For non-payroll, same thing. You can look at paid or incurred. Those are key words. The one thing to keep in mind on non-payroll cost is you do not have that alternative payroll covered period. You have to use the standard default covered period when calculating those non-payroll cost amounts. So with regards to loan forgiveness, what's really important here is all forgiveness is not lost. You have to meet that 60% payroll use threshold to meet the full forgiveness amount, but it can be a sliding scale proportion. So there might be full forgiveness, there might be partial approvals, but that's a key benefit and a key win for the borrower as well. A couple of key items as it relates to the loan forgiveness. So, you know, it's almost like there's 3 buckets you have to work through in terms of the loan forgiveness and the application. How you use the proceeds for payroll versus non-payroll is the first part of the equation. Then you need to look at 2 other buckets. So one of those is, did you reduce compensation for any employees earning less than $100,000 greater than 25%? If you did, then you have to take that reduction amount and it reduces your loan forgiveness. There are some safe harbors out there that you can take advantage of, such as if you restore wages by the end of the year or the end of your covered period. You know, it's interesting because you can restore wages, but you don't have to go back and restore that amount to those employees. You just have to restore back to the compensation or the hourly rate by that safe harbor of December 31st. And again, looking at that, you're looking at each employee. You're not looking at it on a total basis there as well. And then you also have to look at your FTE count. And I think this is one of the most complicated pieces of the application. You have to look at your FTE counts based on certain covered periods in the past, and you can elect which one benefits you the best, and look to see, are you at least that threshold or above? If you're falling below, there are still some exemptions that you can take advantage of. There's the rehire exemption, meaning you reached back out to someone to rehire them and they decline your offer. You have to document that in your files. But there is still a safe harbor again, that you restore your FTE level by the end of the year. If all else fails, there is still another safe harbor that's available to you, that you're just unable to return to the same level of business activity that existed as of February 15th of this year. So there's a lot of safe harbors out there that you can take advantage of. I think when looking at this December 31st threshold, it's important, because I know a lot of people want to get the forgiveness application submitted, but you certainly don't want to leave anything on the table if you can. So if you need to take advantage of the safe harbors, you need to consider them. Keep in mind, if you did obtain a PPP loan above the $2 million, you will have a loan review conducted by the SPA, and there are certainly some specific certifications you have to provide for. For record keeping purposes, for payroll purposes, you need to maintain bank account statements, third-party payroll service reports. You need to have your 941s available. So a lot of different information that you need to have in support of all the payroll costs that you have accounted for on your application, as well as account for the number of FTEs and the pay rates during that period. So a lot of this is so important, just to maintain this really clear trail, both for the lender, the SBA, and to have it in your supporting documentation. Same thing goes for any non-payroll costs that you account for. You need to have maintain a documentation of any canceled checks, the utility invoices, account statements. There's also public disclosure there, certainly for those that received PPP loans above $150,000. There's information out there regarding those organizations. And for those that received less than $150,000, the information is very limited as to what's available for public disclosure. So what if it's not forgiven? You know, we've said, gosh, when we were facing the first bit of the country closing down, I mean, we've been through worse things. So if you have a piece of your PPP that's not forgiven, it's not the end of the world. You're going to have to repay the principal and interest. There's no prepayment penalty. Depending on when you took out your loan and what you agreed to with your borrower, you may have a 5-year term, you may have a 2-year term. And worst case scenario, there's a 1% interest rate. That's a very low interest rate. So again, that's not the worst thing in the world if there's a portion of it that's considered not forgiven. So I'm going to move the transition to Mark at this point to talk about a lot of the tax considerations that are on everyone's mind as we kind of close up 2020.
Thank you, Debbie. So the slide that I've got up now, if you're the kind of folk that likes to take snapshots of slide decks as they're going by, that used to happen a lot more in live presentations. But if you take a screenshot, this is probably the best screenshot you can take today, because it's kind of summarizing kind of where we stand as of this morning in terms of what tax considerations we need to think about. And then we're going to dive down into some details, but ultimately, one of the nuances that I think people expected when the PPP loan provisions were passed is they thought that the idea was the government's essentially subsidizing companies through this tough time, and then through these loans, and as long as you were kind of towing the line with the loan process and using those loans for qualifying expenses, then the government was going to try to do their best to do everything they could to ensure that you were forgiven that loan amount. And then in no one's mind did they think this is going to be taxable income to me. It's basically income as part of as a federal protection loan program, and so these funds can be excluded from your taxable income. Everybody felt pretty good about that. That's what everyone expected. Then, and Debbie's talked a lot about the good news and the very pro-taxpayer news that's come out. But then Treasury stepped in with the long-standing yet unexpected rule in this case that said any of the expenses that you paid with your PPP loan proceeds as of this point in time are not going to be deductible. And that's actually based in a very long-standing rule that says any expenses that you paid with tax-exempt income, you end up having non-deductible expenses. You see that a lot in financial institutions that have municipal bonds and other tax-exempt income-producing property. They end up having to make an allocation of expenses, and they have this adjustment. So it's a long-standing adjustment, but I've talked to a lot of people about it, and this is where the expectation versus reality gap was at its largest, right? Everybody kind of expected tax-exempt income. Most people didn't expect the non-deductible component of that. So here we are in early December. We're trying to figure out what we can do to potentially plan for these non-deductible expenses. And so one of the things that surfaced, and I had several people ask me this question, is there a way that we can say we didn't get our forgiveness determination passed down to us until 2021? Is that going to be a 2021 issue, or is that going to be a 2020 issue? And so I will tell you, we're going to talk a little bit more in depth about it, but spoiler alert, that's still going to be a 2020 issue. That's going to be expenses that you're going to have to consider as non-deductible in the current year. So but I'm going to talk a little bit more in detail about that. The other thing that I'm going to talk about, and Debbie's kind of alluded to a couple of these, is kind of a real inherent need to do a good job of estimating where we are from a tax perspective. And so I have several clients, and Debbie has several clients that we're working with to try to do the absolute best job we can at estimating where the forgiveness calculation is going to fall out, so that we can then apply that percentage to the expenses that we paid, and then we can make our tax adjustments and then see kind of where we're going to fall out, so that we can try to do any last end of the year tax planning that might help us avoid kind of a large tax cash bill at the end of the year. So that is going to be kind of a critical component of what we do over the next 29 days, is making sure we understand where our forgiveness is going to lie. And Debbie also alluded to this, and I'm going to just reiterate it because I think it's kind of a critical item. Forgiveness is more going to hinge on the FTE components and any changes that you make to payroll rolls, if you will, as opposed to qualifying expenditures. Because once they move that covered period from 8 weeks to 24 weeks, most people were going to have enough covered expenses to where they felt like they're going to be pretty good through that first hurdle of forgiveness. So that's going to be a key part of the tax estimate. Debbie touched on record keeping in a huge way, and I think she's done a very good job of basically illustrating the need to keep your records. This up-to-date information is a little bit of a nuance, and I'm going to tell you, if anybody's out there on Twitter, one of the most amusing hashtags you can follow is #TaxTwitter, and there's several people on there, very, very well-renowned tax thinkers that subscribe to this tax Twitter hashtag. And as of yesterday, they're starting to basically put out this idea that the latest legislation that's being considered, and it's being considered in a bipartisan way, has some potential to change the rule for these particular expenses to make them deductible. And so we're going to have to stay tuned. So getting up-to-date information is going to be critical, especially as we work through the end of this year. And another spoiler alert, Congress sometimes makes legislation that's retroactive to the prior tax year. It doesn't happen all the time, but this is one of those situations where It could happen, especially if it's a taxpayer favorable decision or taxpayer favorable legislation. There's a real possibility that there's going to be some changes either late this year or maybe even early next year that might change our results. And so that's why I put the last point up there. Extending your 2020 tax return might be the best play, especially if we're still getting additional guidance, getting additional legislation that might change your tax answer. So Debbie, if you click to the next slide, I'll do the same here. I think I'll do the same here. So I talked a little bit about expense deductibility, and I talked about the complexity of making these preliminary forgiveness determination calculations so that you kind of know what you're looking at from a tax planning perspective. Unfortunately, or fortunately, depending on your perspective, the forgiveness determination is subjected to a relatively long timeline, which means by the time you submit your forgiveness application, you have approximately, your lender has 2 months to look at it, and the SBA has an additional 3 months to look at it. I think I'm getting that right. But ultimately, so you're talking about 150 days. That's the better part of 5 months that your loan forgiveness application could be in review. And so to the extent that that happens, a lot of people are asking me, well, what's the timing of this application need to look like? Once the revenue ruling 2020-27 came out, and which essentially states that if you can reasonably expect to get any portion of your loan forgiven, then you have to take into consideration the expense deductibility in 2020. Once that ruling came out, the idea of trying to defer your forgiveness application kind of lost a little bit of its luster. But ultimately, you're still looking at forgiveness applications that are submitted right now, in all likelihood, are going to be at the close of April before they're reviewed in their entirety. So that's past everybody's deadline. So I just want to say again, extending your 2020 tax return might be advisable. It might be necessary because ultimately we'll want to have those forgiveness determinations levied down or communicated to us before we file our final tax return. But and I alluded to this before. I go to a lot of classes where they repeat themselves a lot. I'm trying to repeat the important points. If you can do a detailed calculation of your expected loan forgiveness, then you can apply that percentage to the expenses that you paid, and then try to get a better feel for it. You can do those estimates, and you can file a return based on those estimates. But unfortunately, because of this ruling, if you do that and there are subsequently different forgiveness determinations made than were estimated, you need to go back and capture that on an amended return. That's a little bit clumsy, and so that's another reason why potentially extending your 2020 tax return could be advisable. And one other thing, the CARES Act was a little bit more comprehensive than the PPP loan program. So I kind of wanted to just quickly touch on some of the tax planning ideas that came out of the CARES Act that could help mitigate one of these tax issues that's being caused by the PPP loan forgiveness and the expense non-deductibility. One of the things that got a pretty good amount of press in tax Twitter land and other places, but something that I want to make sure I draw your attention to here is the qualified improvement property definition that was mysteriously omitted from the TCJA back in late 2017 got restored. And what that means is if you have qualified improvement property to essentially your real property holdings in the form of leasehold improvements typically, or some maybe other build out, those have historically been 39-year property, and that's or long-lived property. So if it could be 27.5 year, but it's essentially long-lived depreciation methodologies that are in play there. This CARES Act restored the bonus depreciation favorable qualified improvement property definition. So what that means is improvement property that qualifies in terms of other definitions, and we're going to omit those from this, but if you have questions, you can certainly reach out to us. Those now qualify for bonus depreciation, and that was made retroactive to TCJA. So one of the opportunities that you have from a planning perspective is if you had significant amounts of real property additions in terms of improvements, then there's a chance that you've got now to go back in, recalculate those depreciation items using bonus depreciation, and then you'll take advantage of that through a 2020 tax accounting method change, if you will. And so that's one particular area, especially if you're a real estate developer, if you've got a lot of real estate holdings, that's one area that might be of benefit to you. Another opportunity lies within the revised NOL carryback rules. So TCJA, among other things, started limiting the amount of NOL that you could carry forward any given year. It also eliminated the carryback period. Well, CARES Act restored actually an elongated carryback period, which gave us the opportunity to now go carry back losses up to 5 years. And then that way, if we are carrying back some losses to tax-paying years, then that can help generate some cash in the form of refunds that might have taken longer to obtain through an NOL carry-forward situation. So if you have if you're looking at a tax loss for 2020 because your business has contracted, as many people's have, you might have an opportunity to go back to any of the tax-paying years that you had previous 5 years and take advantage of these carryback rules. The real kicker, and not many people use C corporations anymore, they've fallen out of favor because, candidly, they're politically tainted a little bit by the big bad corporation mentality. But if you're a corporate taxpayer and you're sitting here at a 21% rate and you're generating losses at a 21% rate, there's some advantage that you can take above and beyond the typical refund of tax, which is you're carrying back low rate tax year losses to relatively high rate pre-TCJA tax years. And so there's some potential supercharging you can do of that NOL carryback if you happen to be a corporate taxpayer. That's pretty exciting to me. I spend a lot of my time dealing with corporate tax clients. So, but if you have any questions about that, certainly let me know. There were also some AMT modifications in CARES Act. So if you have AMT credits that you're carrying forward, those become 100% refundable. And that's something that additionally you can get refunds by carrying back those, or by filing a refund claim to claim those credits against any cash liabilities that you had. So there's a special form out there, quick refund claim form 1139. If that's something you're interested in exploring, that could be available to you. If you want to hit the next slide, Debbie, that'd be helpful. There's two types of taxpayers out there that are looking for opportunities to plan. And most of the trickiness is coming from cash basis taxpayers, but I'm going to talk a little bit about accrual based taxpayers first, just because I think there's some opportunities that we can still leverage as an accrual basis taxpayer. If you've got any accruals that you've made under what I'm going to call the recurring item exemption election, then those can still be leveraged to reduce your taxable income in 2020. And let me say that in a more simple way. If you're an accrual basis taxpayer and you historically had accrued wages at the end of the year, but you have them at the end of every year, the IRS gives you the opportunity to say, you know what, that recurs every year on your tax return. So as long as you pay those out within, in some cases, 2.5 months, in other cases, 8.5 months, then we'll go ahead and let you deduct those on your current year return. So a lot of times there's some opportunity there, especially if you are wanting to accrue some bonus pay or things like that as an accrual basis taxpayer. You have some opportunities there. I will say this, be careful if you're in a situation where you're a closely held company and you're accruing bonuses to people that have ownership within that company. Sometimes there are limitations on the amount of accruals that you can take in the current year if you're talking about accruals to owners. But if you're talking about line employees, then you can really take advantage of that opportunity. There are some circumstances where payment is performance under this particular regulation section, and I'm just saying that as a caveat to what I was just talking about. If you are, there are certain instances, royalties are an example, warranty payouts are another example. When you pay those, that's when you get the opportunity to deduct those. So you can't advance, you can't accrue royalties, or you can't accrue warranty expenditures in advance. So that's so be careful about that particular issue. The other, and potentially the largest opportunity for cash basis taxpayers would be to trying to identify places where you needed to have capital expenditures, enhance your equipment, grow your footprint, however you need to do it. Capital expenditures still have very, very favorable terms in terms of current expensing, either under Section 179, which candidly gets a little bit better treatment for Tennessee purposes, or Section 168K, which is bonus depreciation. Those rules that have been in place for a while, coupled with the qualified improvement property definition correction, can give you an opportunity to think about doing some capital expenditures at the end of the year. One other thing, and this is kind of an all-encompassing thought that I want to share. We're trying to be careful about taxes. We're trying to do everything we can to minimize taxes. But at the end of the day, we also need to be mindful of operating our business. We also need to be mindful of what we need to do to make sure that we're in a good cash position or a good working capital position as we go into 2021. And so what I want to encourage everyone to think about is, let's not be so concerned about a tax liability to where we do something that'll put us in a dire position in terms of our working capital. So always be thinking about, where does this put me from a cash flow perspective? Where does it put me from a debt service perspective going forward? Be mindful of those things, but I do think that there's some opportunity to do some tax planning. Cash basis taxpayers, and Debbie, you can move the slide forward, have a little bit of a trickier proposition, because one of the things that cash basis taxpayers, especially in the medical field, are worried about is some of these advance payments that they've gotten in other aspects of the CARES Act, that ultimately, as soon as you get cash, that's income to you. You make expenditures, those are expenses to you. If you're getting advance payments in the form of revenue and you're not getting the expenses to match up with that, you're getting kind of a really strange answer in terms of your taxation for 2020. That's not going to be the case for the most part for PPP loans, because you should have expended those dollars before the end of the year. So that's not as big a play, but ultimately you do still have a couple of opportunities in front of you. The capital expenditures that I just talked about, if you have the cash wherewithal, or if you have the financing available, you can make some capital expenditures, get immediate deductions for those, and then take advantage of that deductibility in 2020. The other thing that I'm seeing, and a lot of taxpayers are considering this, if you have the opportunity to pay out in cash year-end bonuses prior to December 31st, then that is a great way to get additional deductible expenses on your books before the end of the year. One of the tricks is we need to be careful about cash flow, as I was talking about, or just your cash position. And then the other thing you need to think about is the restrictions for closely held companies that might preclude you from deducting some of these things. But one of the things that's available to taxpayers, and this is a little bit of the sophisticated planning potentially that might be out there, is if you have the opportunity to bonus out payments to closely held ownership, and you paid those out in cash prior to the end of the year, but that was going to put you in a bad cash spot. You have the opportunity to either have those owners buy additional shares, maybe out of Treasury, maybe you've got non-issued shares that are out there. Do they have the opportunity to loan that money back to the company and then have that be part of your debt structure as you go forward. There are some possibilities there. That's one of those things that I would be extremely cautious about doing that unless you are talking to your tax advisor to make sure that you're not putting yourself in a strange spot in terms of debt, equity characteristics, and those sorts of things. So be mindful of that, but there's an opportunity there. One of the people I work with has had a very wise thought when we were talking to one of our clients about this. He said, once you pay wages, you've paid wages. And so if payment of wages by the end of the year is going to put you in a weird cash spot, just be extremely cautious about that, because once you've got a W-2 issued, once you've got payroll returns issued, those wages are out there. And I put this in this context. If you're making payments on wages and then suddenly legislation gets passed, let's say for argument's sake, it gets passed on January 31st, that retroactively says if you paid expenses with your PPP loan, they are now deductible. And just out of the goodness of our heart, government says we give you that deduction. Now all of a sudden you've got wages that are out there, they're paid, it's additional expenditure. Now suddenly you're creating a loss position. So just be careful about that. You've got to strike a fine balance as we think about planning going forward. So we'll move to the next slide, Debbie. As I've been talking about, and again, I repeat to try to make sure that we're stressing the right things, cash management might need to take precedence over tax mitigation. And so let me give you an example. This is a generic example. If you've got a partnership and because you're having to add back expenses, you had a $2 million PPP loan. So all of a sudden you're not getting to deduct $2 million worth of wages. So all of a sudden you find yourself passing taxable income through to your partners. One of the provisions that we've talked about is trying to reduce that taxable income number. And I think that that's definitely a possibility. But one of the other considerations is, does your partnership agreement dictate that any of the tax that you're generating through passing through ordinary income to your members, is there a provision in the partnership agreement that makes you pay 40% of that amount out in tax distributions by April of the next year? Let's make sure that we're thinking about those things. And that's kind of what that second point is talking about. If you can't mitigate your tax and you're going to pass through tax to a set of pass-through owners, then there's a possibility that your partnership agreement stipulates you've got to pay those partners for the cash liability that they're incurring because that income is passing through. So be mindful about that. And then, of course, one of the things that I've talked a little bit about already is there's a possibility that extending your 2020 return, it might be the best path. That gives you some additional time to make sure that if you're thinking about doing some of the accounting method changes, especially related to qualified improvement property, it gives you time to coordinate what that looks like, to try to quantify that. Let's try to figure out what we can do to get our best tax answer possible. It also gives an additional window of time for legislature to pass rules that would allow for potentially a more taxpayer favorable result. So if this legislation that I started seeing about last night on tax Twitter comes to fruition, and it sounds like it's got bipartisan support, if that deductibility is restored, then we can take that into consideration on our 2020 return, and then all is right with the world. And I've talked a lot about, in all aspects of my life, I talk about where we have trouble as tax professionals is where there's an expectation reality gap, right? I think everybody, like I said, expected tax deductible income, or they expected their income to be non-taxable. They didn't expect for their deductions to be added back. And so I think the legislative intent was that those expenses match up with deductibility. I think legislature's going to try to get it right, but if I was going to put money on it, I'm not sure that gets passed. I think legislature is worried about different things right now. And so I'm hoping that this gets passed, and I'm hoping everybody gets a better tax answer as a result. So one last slide I'm going to talk to you about, if you'll click forward, is we have some information, and PYA has spent many hours and over the last, let's call it 8 months, pulling together as much information about COVID-19 and about the PPP loan process and about other CARES Act components. And we've got it all stored on the PYAPC COVID-19 hub. You see the link there. We'll make sure it's available to you over the course of at the end of this presentation. There's also a link to the Treasury Department, the Assistance for Small Business link there that you find. That also has some helpful information. So if that's something that you're interested in going out to explore, certainly I encourage you to do that. But more than anything, and I hope everybody's seen it, I don't see anybody's face except for my couple of friendly faces that are helping me present this material. But if you have questions out there, it looks like we've got 3 or 4 questions over chat. I'd love to be able to answer them for you. As I was talking about earlier, or as was mentioned earlier, a lot of people's facts and circumstances are unique, especially if you've got some changes to your full-time equivalent number that might be caused by something else. For example, I saw one chat question just pop up, and I don't remember the name of the person, and I don't remember exactly the details of the question, but essentially the question related to the fact that sometimes people retire or people leave your employment roles for reasons other than a COVID-19 response, or sometimes it's a voluntary departure. Those are certainly things that they've considered, and there's special rules for taking those into consideration when you're doing your forgiveness calculation. So and we'll answer the question that was asked more specifically, but those are the sorts of nuances that I think will be a challenge for people as they try to estimate what their PPP loan forgiveness looks like, and as a result, estimate what their deduction add back, at least as of right now, might look like. So we're happy to help you. I've put in the chat mine and Debbie's email addresses. I've also, in the very first part of this slide deck that I think will be distributed, they can also be found there as well. So I encourage you to reach out. I've got that we're slightly over time because I think this is a 50-minute presentation, but if you've got questions, I just encourage you to reach out through the chat function. Debbie, I'll give the floor back to you. Do you have anything else you want to add, any clarifications that you want to mention at this time?
No, I appreciate everyone taking time with us. I know we'll connect with Tammy to get the questions from chat.
Yeah.
So
Excellent.
Mark, Debbie, thank you all. This is so helpful. Well, first of all, it all confuses me like crazy because that's just not my area. If you want to talk about marketing networking, I can talk your head off all day long. So I really have to think about and study on what you all have said, but such a valuable resource, particularly for the small business community. I think I talked to some folks in your firm not too long ago. You all will be coming back to see us at least first quarter next year, maybe presenting some update information, because it feels like this saga may continue on for some time. So I would love for you to come back and help us yet again. I will encourage you, our participants, if you want the slide deck, if you'll just pop your email in the chat and we'll make sure that we get it to you. Trudy Hunley, we will follow up. They will follow up with you on your question. Don't forget to visit PYA's website and just take a look at their resources, because as a small business, sometimes it is just so hard to navigate and to make sense of it all. And so I want to say thank you again for that. We will also have a recorded version. So if you missed part of it, you joined us late, you can still go back and watch that. We will send it out in our normal email channels on Monday morning. Will also be on our website, which is www.bluntchamber.com.